1,685. Gautam Dugar is Head of Research, Institutional Equities at Motilal Oswal Financial Services. Motilal, of course, publishes, a results preview before every quarter, pretty much a Bible if you want to get a snapshot view of what street expectations, market expectations are. Of course, they also have one of the widest coverage in terms of companies and stocks. Gautam, great to have you with us here. Thank you very much. Just lay it out for us, top down, what are the big themes to watch out for in this earnings season?
Hi, Prashant. Good morning. Thanks for having me. See, this quarter will defy the prevailing narrative because last 6 months, all we've been hearing is input cost going up, thanks to the geopolitical situation, which is still unfolding. But what we have seen third quarter, which is the quarter that has gone by, and what we are expecting this quarter is completely different. If you compare it with the conversations that most of the people are having, we are expecting about 20% earnings growth for our coverage universe and roughly 23% for Nifty. And this is coming on a very high base. If you look at March 21 quarter, which was the beneficiary of a low base of the first lockdown of COVID in March 20, we had about 100% growth in March 21. So if you just look at 2 years CAGR is about 50%. If you look at pre-COVID and compare it, 3 years CAGR on earnings is roughly 22%. So which is pretty healthy. And if you had asked somebody 6 months back that you're going to see a $18-20 billion of FI sailing, crude will be 100 plus, and war will be breaking out, we would have perhaps not guessed the market levels to be so resilient. And similarly, earnings also we would have expected a lot of cuts. While we have seen some sector-specific cuts in auto, cement, consumer durables, and to an extent in some of the other smaller sectors like specialty chemicals, but it's got more than counterbalanced by the upgrades that we saw in commodities and fairly stable earnings stream in IT and financials. So when I talk about a 20% earnings growth for MOSL coverage and 23% for Nifty, 50% of the growth, or more than 50% of the growth, is coming from financials, and another 30 to 40% of the growth is coming from oil and gas and IT. So those three sectors actually account for 90% of the incremental growth. And what is drag is auto continues to remain a drag, 14th quarter in a row. Cement is a drag with a big decline that we're expecting. And the third sector where we're expecting a YOY earnings decline is specialty chemicals. But all said and done, our forward earnings estimate revision is still very stable. If you recall, we started year FY22 at an EPS projection of 730 rupees. We are virtually going to end the year at 732 rupees, which will be a growth of 35% for a full year. And Prashant, you would recall, this is the highest growth that we'll be logging in almost 18 years. This is highest since FY04 if these numbers are met. And our next year's forecast is at about 19% for FY23. So virtually no change in earnings estimate, despite all the headwinds that we have seen for the last 7-8 months.
Okay, so this market has showcased resilience yet again, right? Gautam, hi, good morning. I want to go through your note because there are some very interesting takeaways from there. What stands out for me is that you have a preference towards these real estate names. You've added Macrotech into your portfolio. Not just that, you like some of these home building themes as well. So something like an APL Apollo Tubes, which is the largest steel tube manufacturer. Is this a theme that you're playing which could be a multi-year theme for retail investors?
Yeah, hi Sonia. So basically, if you look at the construct of a model portfolio, the core has not changed at all. We've been running the highest overweight in IT for 2.5 years running. We still have the highest overweight on IT at about 300 basis points. Financials is the second highest overweight at about 200 bips, and then consumer at about 100 bips. These three sectors together comprise about 65% of our model portfolio. What you are mentioning is some of those tweaks we have done in this round of model portfolio revisions, where we are trying to play the opening up thing. Hopefully that we are not again going back into lockdowns, touch wood. So economic recovery with the full face of opening up will get stronger and stronger. And that is what some of the model portfolio additions, especially in the mid-cap segment, you would see. Whether it is Macrotech, whether it is APL Apollo, or some of the modifications we have done. We have removed Indian Hotels, added Lemon Tree. We now have 2 QSR stocks in our model portfolio. We have also added some stocks in mid-cap cement where there has been a massive correction. Something like Dalmia you would see, while we continue to have Ultratech. So the core of the model portfolio has not changed. We still have big overweights on IT and financial. And then at the margin, we have made some tweaks. So you will see a JSPL in place of SAIL. We've gone overweight on pharma from neutral. So that is one big sectoral change that we've done from a neutral call on pharma to overweight. And auto, we have further reduced the weight. So we've been underweight for some time. We've now reduced it from 4 to 2%.
Gautam, good morning. In fact, that was my question to you. Autos, you have been underweight, and as you said, you've increased your underweight. We had a contra view on Thursday, that perhaps commodity prices might be peaking, and if demand comes back, then the commodity consumers could well be the place to go to. You think it's perhaps, is it early to get into autos? You think there's still more challenges than just the commodity prices? I'm thinking in terms of risk reward, whether it's getting favorable for some of these names now.
See, Anuj, when the sector underperforms for 4.5 years, this is the 5th year of a down cycle for auto. The earnings and the volumes peaked in FY18, and we're yet to reach those levels, and we're approaching FY23 now. So when the sector has gone through so much of an underperformance, obviously the risk reward will optically always look very favorable, especially valuation, because two-wheeler stocks are at 13-14 PE for last 5-6 years, and still they haven't given any returns. The problem in this sector, in my view, so far as of now, is the demand is an issue, supply is an issue, and also at the margin, input cost has not been favorable. So we have now seen 14th consecutive quarter of earnings downgrade. And my view is the next 2 quarters also you will continue to see earnings downgrade. At the margin, there will always be trading opportunities in some of the stocks because you keep getting monthly numbers. So some company somewhere may end up surprising for a month. That stock may move 5-10%. But structurally, I'm still not getting that, feeling that things are, the worst is behind, because volumes are still looking very, very edgy. And therefore, I think in an environment where I'm expecting a 35% growth, which is already delivered in Nifty for FY22, and next year about 20%. So earnings growth of the market is looking extremely strong. So it's not as if that there is a dearth of opportunities. So I want my capital to be deployed in a sector where earnings visibility is far stronger. Having said that, valuations, obviously, I take your point that they are looking quite juicy, but the triggers are still not around. And if commodity prices were to correct, I would think the better option would be to play through B2C consumer staple companies, because that is where the underperformance for last 3 has been extremely strong. And the pricing power those companies enjoy is far stronger than automobiles.
Okay, just one second. I just want to pull out the listing of Veranda. Now just pull out the prices on both BSE and on NSE. I think the reason for that is that on NSE, I think it's already at upper circuit. I think based on what the pre-open settled at. So on NSE, you have pending buy order of 24.2 lakh shares. That's pending buy order on Veranda at 131.25, which on NSE is the upper circuit price. And if you see the BSE, and remember it's T2T Veranda, and if you look at the BSE, on BSE the upper circuit is 164.85. And actually the stock, there's a lot of fun and games happening on that one. On BSE, it's actually 16-17% higher, and the rates are changing so fast on BSE. Just look at the bid and ask, the differential. Prashant, this is something, we learn something new every day.
This is almost, overnight price and the next morning price, right? Or a different market altogether. I've not seen this. A new listing, a lot of interest, volumes are not thin or anything of that sort. And there is a big difference in terms of both the prices. Side by side, they tell you the story. One is actually lower, the other is actually higher. And there is a 20-30 rupee difference. Between 30 rupee difference, right?
It's not that there's an arbitrage available, because on NSE it's frozen. This is the upper circuit. So, a lot of people might think that you can buy on NSE and sell it on BSE. It won't work because on NSE it's frozen.
You cannot.
Absolutely, yeah. Just to put it in perspective, this is a loss-making company. Let's not forget that. The last 6 months FY22 numbers, they posted a loss of almost 19 odd crores. They are into integrated learning solutions. Gautam, just a quick word here. If not on Veranda particularly, then on this industry, which has of course been through its own ups and downs over the past many years.
Which industry, Sonia? Sorry.
The new listing that we're seeing, Veranda.
Yeah, no, not too familiar with this one.
Okay, okay. Just coming back to the note that you put out itself, one other standout feature for me is that you're still bullish on some of these pharma companies, specifically names like Apollo Hospitals that have given great returns in the past. Now, of course, there's a bit of stagnation in terms of performance. What do you think the next big trigger could be for names like Apollo?
Yeah, so as you rightly said, pharma has actually as a sector underperformed after the FY21 strong returns after staying stagnant for almost 5 years in terms of both earnings and relative stock performance. Now, some of that is normalizing, obviously. So Apollo specifically has had a very strong run. Then it entered Nifty and has now been, I think, around a similar price for some time. What we are excited about as far as Apollo and the broader hospital space is concerned, there is enough room for operating leverage in that segment, given some of the key operational parameters where they are standing at today. And if the occupancies were to go up a little bit, I think the operating leverage that you can derive from that business model is quite significant. So that obviously helps your ROE. Second, as far as Apollo is concerned specifically, the bigger part of the excitement obviously lies outside of the hospitals with the digital and healthcare and pharmacy business, where a lot of anticipation is there. And that is where I think the next catalyst and trigger is. As far as other stocks that you mentioned in our portfolio, pharma actually is not a very uniform sector. Every company has its own different fortune. So it's like a congregation of 10 or 15 sectors, unlike a cement or an IT or a financials where one theme decides the fortunes of almost all the stocks. In pharma, you have to be very stock specific and bottoms up. And that is where we have included or reintroduced Cland in our model portfolio, where we are expecting about 23-24% earnings CAGR for next 2 years. And Divi's, as you're familiar with, has been delivering very strong, consistent earnings compounding for last 4 years running. And again, we are expecting another year of more than 25% earnings growth for the next 2 years. So that is what explains our view when we raised the sector weight from neutral to overweight now.
Okay, we will slip into a short break. On that note, thanks a lot, Gautam, for joining us and helping us prep for the quarter to come. We kickstart earnings season today with TCS's numbers later in the evening. When we come back from the break, Mitesh Thakkar and Prakash Gaba will join in for some technical trades. Stay tuned.
A vision